righty. Thank you, Cheryl, as always. Hello, everybody. Thanks for being here. We'll be going through Due Diligence 201. It can be a dry topic, but is a very important topic as we talk about angel investing. There's a good place to start, which is a checklist. When you do diligence, for those folks who are unfamiliar with the term, we're basically researching a company for possible investment. And there's a lot of areas to cover as you research. You probably do want a checklist as you sort of evaluate opportunities. This sample one, for example, covers what's the investment status. By that, we're talking about where is a company in their cycle, market, how big is the market, what's their product in the market, who are they up against, what's the competition look like, what are their financials if they've been around for a while, how are they doing, how do they make money? When people talk about business model, that is really what we're talking about. Team, very important. This list is not in order of priority. Everything on this list is important. And then legal compliance and anything else that you might need to check. After due diligence, you should be pretty familiar with the company. You will want to know the ins and outs and be able to sort of answer questions yourself about the company. That's sort of how you know you really know it, is when you can answer questions yourself. So a couple of the basic information you'll want: what's the company name, website, what industry are they in, what's the description, who are the founders, and then what's the entity type. Most companies tend to be Delaware C Corps, but that can vary. And then you'll also want to start looking at the investment itself. What's the financing history? Who's invested before you? What terms did they invest at? What's their current cash position? What that typically refers to is, besides just a raw number, how many months of runway do they have? And by that, if they sort of were steady state on revenue, how many more months will they be in business? And then this current financing, how much more runway will they get? Another sort of question to ask is, oftentimes companies are raising to grow, so they will be burning through that capital. So it doesn't necessarily mean that the expenses will stay the same. So something to sort of discuss as well is, how much are they raising and what will that money go towards, and will that increase or decrease what's called their burn, what they're potentially losing every month if they're not a profitable business. Let's talk about the market. Market is important. Oftentimes markets can be too big to understand, so you kind of want to go sort of bottoms up as well as top down. So if a company is in the telemedicine space, okay, well, what does that mean from a massive number? But let's say they're doing pediatrics and telemedicine. Okay, well, let's talk about pediatrics specifically. Let's talk about pediatrics not in telemedicine, right? What's sort of the market that they'll be bringing over into the telemedicine opportunity? So when you talk about market, there's a few ways you want to kind of cut it. It's sort of where they are today, where they're going to be growing into. And another way to talk about this also is, are they taking a slice of someone else's pie, or are they growing the pie? And maybe they're doing both. Go to market. So typically companies, when you're investing at the early stages, are early in their go to market. Hopefully they have figured out what is often called product market fit. And by that, it's their product is in market. They have customers that have given them positive feedback. Maybe they even have a high, what's called an NPS score, Net Promoter Score. So those are sort of the things as we talk about go to market is, do they have product market fit, and then how are they going after their customers? Now, we could spend a whole webinar specifically on go to market. B2B might have enterprise sales. B2B means business to business. B2C might be they're acquiring customers through communities or through online advertising. So we really want to understand what the specific go to market is for this company. How are they going to basically grow their customer base, grow their revenues? What are market trends, market growth? And remember, these can change. Market trends, obviously, with COVID have shifted a little bit. Things that were doing phenomenally well in 2019 may no longer be doing as well, and vice versa. Things that were sort of quiet up until COVID are now taking off from a trend perspective. So you'll want to pay attention to market trends in consumer behavior or if enterprise customers are in play, enterprise customer behavior. And finally, market growth. Maybe the company is targeting a small but fast-growing market. That's great. If they're targeting a slow-growing but huge market, that could also be fine. But if they're targeting a small and slow-growing market, you really want to probably dig in and understand how big the company can really be. Perhaps they believe, and some companies do, believe that by entering the market, they'll be able to grow the market, which is possible, but harder to do. Product, again, we're riffing through these. Each one of these could be its own webinar. What is it that they're offering to customers? Usually you want to start, as you sort of diligence, with where the customer problem is. People oftentimes refer to, in fact, in previous webinar, I think the last one, someone was talking about, Fritz was talking about this concept of a painkiller. So are they solving a real pain point, something where customers are aching for an aspirin, or is it more of a vitamin? Sort of, is it a nice to have problem that they're solving? So when you talk about product, before you play around with it, before you look at the look and feel, you really want to get into the customer's head and ask, maybe even talk to customers, what's the problem that the product is solving, and then how well does it solve it? And then as you sort of figure out, okay, here's the problem that the product is solving, how big is the problem, and what other adjacent areas might the product go into as a company executes that will continue to sort of solve that product problem, fill that problem with product. Ripping through these, all of these are super important. And again, we'll have this online later, and definitely you can always hit us up with more questions. Competition. A lot of companies, I shouldn't say a lot, some companies will underestimate competition or underappreciate competition. They believe sometimes that they are so different and so unique that no one is competition, or there are just a few. It is your job as an investor to really make sure that you're holding the founders accountable around what their competition really is. Obviously, they're excited. They're building something that they think the world has never seen, or that is going to make the world a much better place, and that, oh, no one can copy them, or what they have is so unique. And that is a beautiful thing, that enthusiasm, that zest. But it's your job as an investor to give them a reality check. Maybe there are large incumbents that actually are planning on moving into the space. Maybe some Google searches will reveal that someone is actually going to be moving into the space that they say the company's not going to. Or there are a lot of other startups, right, that are maybe going after the same opportunity. You want to see, maybe some of them are well-funded. Maybe some of them are well-funded by incredible investors. So then the question becomes, all right, sure, it's early days, but this is a Sequoia-backed company you're going up against. How are you going to compete with them? Competition size, again, it doesn't necessarily need to be the big folks. You can be the little folks. It could be a lot of folks. For example, sometimes the barrier to entry is so low that you might be first to market, but the barrier to entry is so low that all of a sudden the market's crowded in a matter of months. So these are the things that you'll want to really think about. Again, all of these merit a lot of time. I'd say competition is one where founders sometimes have blind spots. So really do your homework there and push the founders to make sure that you have a good sense and they have a good sense around competition. And competition is not a bad thing. It can be validation of the market, but it is something you want to be sort of well aware of. Financials, how does a startup make money? Business models are important. Sometimes you can look at a spreadsheet that a company sends you and your eyes glaze over. It's, I think, less important to look at sort of the growth, because of course the founder is going to present you with funnels that go up and to the right. What you really, I think, want to dive into are the two things. One, past financials, right? So if they've been operating for a while, what do the numbers look like? And if they're not good, that's maybe okay, but why aren't they good, right? Were they really spending time on product development, and so they weren't focused on customer acquisition? Okay, that's a reason. Or maybe they were focused on the wrong customer and they finally figured out the right customer. So past financials that are quote unquote poor don't necessarily mean pass on the opportunity. You just want to understand why. And if they're great, amazing. But then you want to say, are they inflated? Did the company spend a lot of money acquiring customers very expensively in maybe a non-sustainable way? So financials can be deceptive. You really want to understand if it's past financials, what the context was, and then for forward-looking financials, the assumptions. You really want to understand what the assumptions are. If they're going to grow by X percent, okay, how do we get to X percent? Let's really dig into that. Traction is important if you're talking about customers. It's sort of how they acquired customers. How are they going to acquire customers? What you'll typically hear is at scale. So maybe it's easy to acquire customers in the early days, but as they grow, when other companies come in, will it get more expensive? Will they be able to, if they're in the B2B space, what's called land and expand? By that, people mean land a big account, and maybe get a couple of people within this big company as customers, and then expand within that company. So you'll want to kind of dig into early traction, how they plan to expand that traction. And then balance sheets. What's their current cash position, and how much will this raise by them as far as time? Another thing I'll say about financials is when you do talk about how much they're raising now, typically at the early stages, you want to make sure the company has enough, again, what's called runway, to get to the next round. So one question might be, okay, have you talked, like if we're investing at the seed stage, you may want to ask the founder, if you talk to A stage investors, do you know what they need to see in order to write you a check? As seed stage investors, it's important to understand, okay, this is unlikely to be the last round of financing for the company. They're likely going to raise the next round. What is that later investor going to look like? And is this company raising enough money to hit those metrics so that they can raise that capital in the next round? Team and regulation. Team is, again, each of these is so critically important. You'll hear a lot of early stage investors talk about they back founders, not ideas. We talked about that in this last webinar as well. Who are the founders? I personally, when I'm diligencing, I ask them and myself, why is this founder made to build this company? What unique insight do they have? What unique experience do they have? What unique problem have they faced that they're not solving for others? You want to break down technical versus non-technical. Now, when we're talking about technology startups, ideally, the company has at least one technical co-founder. I won't say it's a deal breaker if they don't, but you'll want to really understand, okay, well, if they're not technical and they're building a technical company, how are they going to build out that team? What advisors do they have? What access do they have? Maybe they just left a company where they have a bunch of friends and they're non-competes. That may not be an option, but just understand how they're going to build that technical company if they're not technical themselves. And of course, prior experience in startups. Startups are a different beast. I know folks that have successfully come from different industries, law, medicine, et cetera, and been incredible founders. But it takes, I think, a different DNA than many other industries to sort of be a founder, hustle. No job is too small. So you want to understand and make sure that the founder is ready to really get their hands dirty and do whatever it takes, especially in the early days. I know we're cruising through this very quickly. Again, each of these is probably on webinar. Maybe we'll get there at some point. Next, sort of on the checklist, is regulation. This is, again, something that you want to pay attention to. It doesn't necessarily mean, oh, they're going against regulations bad. For those folks who remember Lyft and Uber in the early days, it was, I believe, they were going against some sort of regulations around ride sharing. Eventually, they were able to sort of work with governments and get that worked out. I think Airbnb, same thing. I think there may be even some still ongoing questions there. So it's not always a bad thing if there's regulations that are against the founders, the company's path, but you'll want to understand what's the probability. Is this something that is probable that the governments will maybe change their mind on? Have the companies already had those conversations? What's sort of the roadmap? Intellectual property. For those of folks, intellectual property sometimes can be overhyped. Folks will say, oh, I've got a patent on this or patent on that, and patents are great, but execution is oftentimes, I won't say always, a little more important perhaps, because at the end of the day, you can have a patent, but if you can't execute on the idea, it may not turn out as well as you may have hoped. So IP is important. If they have patents, great. It's definitely a plus, but you'll want to make sure they also have the execution chops and execution plans to execute on the opportunity and go from there. All right, I cruised through that, but let's do a few key takeaways here. All right, every startup is different, therefore every due diligence will look different. You'll want the same checklist. Most likely, there may be slightly different checklists for enterprise or consumer, or even within consumer, slightly different checklist if you're talking about a beverage or versus an app or something like that. But broadly speaking, similar checklist, but every company is going to look different, and that's okay. You want to understand why this company, this team, in this opportunity will do well. You want to be organized. So there are tools out there. Maybe just use Google Sheets or something else. Or Google Drive. But you want to kind of be organized in your notes, and especially you collect information. Maybe it's customer interviews. Maybe it's references from previous investors. Just have everything in one place, so when it comes time to making a decision, you have it all in front of you. Length of time for due diligence varies. And I'll say, this also depends on the size of the check. I mean, firms that are writing $3, $4, $5 million checks oftentimes will take a couple months. Firms writing multiple million, $10, $20 million will take several months. Sometimes folks will take weeks. Sometimes folks will take days. Sometimes folks will take minutes or hours. You should always do due diligence. You should get comfortable. If we're talking about angel investing, it is your money. So you have to get to a place where you put in the time and you've done the diligence that you're comfortable making this investment, recognizing with all likelihood it'll go to zero. And if it does, you can look back and say, you know what? I feel comfortable with the amount of diligence I did. It went to zero. I made a bad decision based on the diligence, or I didn't do enough diligence, but that's on me. The length of time varies. It really is at your comfort level. We recommend, of course, running through this checklist and doing due diligence to the point of comfort. While you cannot know everything, due diligence should ultimately allow you to make an informed decision. And one thing that is worth mentioning is sometimes due diligence works both ways, not always, but don't be surprised if a founder says, hey, so tell me about yourself. What are you going to bring to the table? They'll may even want to chat with other founders you've invested in to understand how you interface with founders. So don't take that the wrong way. Frankly, it could be a good thing. It means they're serious about having you as a partner in their journey. So within reason, I'd make myself available to offer materials about my own background, or you for your own background when chatting with a founder that wants to learn more about you. Because ultimately they're bringing you on their journey and they're trusting you for the long haul. Okay, we're now going to talk a little bit about how to read a Form C. Now, if due diligence sometimes can be a little eye-glazing and overwhelming, Form C, it falls in that category, but it doesn't mean it's not important. It's something that on Republic, you'll find a link to Form Cs, and it's a part of due diligence to click through and understand what's there. What is a Form C? Form C is an offering statement for crowdfunding investors to review the offer. So, when regulation crowdfunding is regulated. So these are forms that are filed with the government that contain issue information, intermediary information. What's the platform? If it's Republic, it's Republic. Financial disclosures that the startup has provided, and then exhibits to sort of support the financing. A lot of what you need to make a decision will be there. In addition, of course, to if you're talking about Republic, what's on the deal page. The deal page is more of a summary, and you can kind of click through for details, if you will. How do you find the Form C? So if you look on a typical deal page on Republic, on the right-hand side of every investment, you will see something called Documents with the little symbol there of the SEC. You click, and it takes you to, I believe, the SEC website. And then from there, you'll want to find the filings and the Form C filing, the offering statement. It is a PDF, and you can from there view the Form C. Again, starts off with basic information. What's the name, the address, the website, and then intermediary. That is where you will see Republic, for example. Let's talk a little bit about the intermediary. Intermediary covers the relationship between the intermediary and the issuer, as well as the type of securities and the maximum offering amount. So things to look for: what's the compensation to be paid to the intermediary? In this case, if there's Republic, how much? What's our what do companies pay to sort of be on our platform? Any other direct or indirect interest the issuer has in the intermediary? What's the type of security that's being offered? We'll talk a little bit about this later in this presentation. What's the target offering amount? What's the maximum offering amount? And what is the deadline? Okay. Financial disclosures. So these are important. We talked about it earlier. It won't answer all your questions. You'll probably, if you have questions, want to try to connect with the founders to understand, okay, let's talk about past performance. What does that mean? How did we get there? Or, oh, I see, your cash position or this, maybe you have some questions. These are, don't hesitate to sort of get to a place of comfort by asking questions around them. But the financial statements of the company will include financial records from the most recent fiscal year and the prior fiscal year end. And always remember, past performance does not ensure future results. So even if you see, for example, tremendous growth, you'll want to really understand where that growth came from and how is the company going to maintain that growth in the future. Revenue and sales growth is important, but don't forget the other categories as well. Expenses is an important line item. They're all important line items. And if you have questions, if anything looks a little odd or off, probably best to follow your gut and try to get an answer to why that might be the case. Exhibits, these are, I think I'm running out of time here, so I'm going to just kind of lip through this slide. Offering memorandum, disclaimers, financials, offering page, a lot of information there. Definitely, again, as part of due diligence, you'll want to kind of go through that. Offering memorandum, that is the information about the business and the offering, risk factors, use of proceeds, team structure. And again, you can have your due diligence checklist and you can kind of look at the offering memorandum and just make notes so that, again, when you make your investment decision, if in 6 years you lose money, you go back and say, you know what, I actually had a question about this and I didn't get an answer to. Or if you make money, you can say, you know what, maybe these are the things I did that this company had in the early days that I should try to look out for in my next opportunity. So you'll want to kind of write down personal notes on your observations on all these things so you can learn as you go. All right. Thank you for being patient with me as I just ripped through that. Let's get a little bit more detailed and fun. I'll turn it over to you, Cheryl, to talk with Natalia.